This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week.
I find the de-dollarization debate a bit frustrating. In aggregate, the U.S. is running a 4 to 5% of GDP current account deficit.
Yeah.
So in aggregate, the dollar long is going up. And that is completely separate from the fact that over the past 10 years, no one has been adding any meaningful sums to their foreign exchange reserves. The real issue is not, is the existing stock of dollar reserves going to move around in some big ways? It probably won't. The real question is, if the dollar weakens, will central banks resume reserve buying and act as a countervailing source of pressure that supports the dollar? That's what past patterns would imply. May or may not happen.
We've spent a lot of time this year thinking about trade, tariffs, and their effects, with an expectation that a more protectionist United States might accelerate a process of deglobalization that's been in place since the pandemic. And the dollar weakness that we saw in response to the shock of Liberation Day also gave rise to thoughts of de-dollarization, again continuing a market narrative that's been in place for a few years. But as our guest this week highlights, none of that has really come to pass. For this and plenty of other insights, we couldn't be luckier to talk to Brad Setzer this week, as he's one of the leading experts on global trade and capital flows, and he's forgotten more about the topic than I'll ever know. Brad's a senior fellow at the Council on Foreign Relations, where he runs a long-standing blog called Follow the Money, which for me has been an essential guide to understanding global trade, FX markets, and capital flow dynamics for more than 20 years. He also regularly tweets his thoughts at Brad_Setzer. As you'll hear, he has no shortage of ideas that are thought-provoking and insightful. Hi, Brad. How are you?
I'm good. Don't have as nice a microphone set up, but looks good.
Trust me, this is still a low budget one. Well, let's get right into it. I mean, I wanted this to be about, well, obviously trade and tariffs. That's been the big story this year. And, you look at the data, I think, more intensely than just about anybody I follow. So I wanted to see if you could start thinking about what trends are you seeing kind of in response to basically the rise of U.S. protectionism, and is it making a meaningful difference?
If you just looked at the trade data without any context, you would say a gigantic shock on the par with the pandemic hit the U.S. in the first and second quarter. And it turns out that was a bit of a false read, because almost all of that shock came from two product categories that are high value but low volume: pharmaceuticals and gold. And ironically, both of them didn't end up getting tariffed. But you had a huge influx of gold and pharmaceuticals in the first quarter, huge fall in the second quarter. And in some sense, the run-up in pharmaceutical inventories has driven the overall expansion in the trade deficit this year. So you kind of have this weird story where two products that don't in the end receive tariffs are actually the dominant factor in the backward-looking data. You also have, and I think this is also going to turn out to be a bit of an irony, you have this huge reallocation of final assembly away from China to Southeast Asia. And so the bilateral deficit with China shrinks, the bilateral deficit with all of Southeast Asia, but Vietnam in particular, goes up. You also have a big reallocation of final assembly of very high-end electronics, servers, switches, and routers, your telecommunications infrastructure, your AI infrastructure, to Taiwan, out of China, using the Taiwanese chips, but have final assembly in Taiwan. And, that's a very pronounced trend. Overall, though, trade with Asia isn't down. It was just shifting around. And now, after a lot of volatility, initially the tariffs on China, the new tariffs were like 30. Then they went up to 140, 100-ish. Then they're back down to 30. Now they're sort of going to be at 20. they layer on old tariffs. But if you just look at the new tariffs, we've ended up with the same tariff, more or less, new tariff on China that we have on Southeast Asia, because the tariffs on Southeast Asia started off at 10 and now we're up at like 19 or 20. You don't see the impact of that yet in the data because everyone had gone into this year based on Trump's campaign promise, thinking there was going to be a lot more tariffing on China and a lot less on the rest of the world. And then I think the final thing you're seeing in the data, two things you're seeing in the data, you're seeing, and this is really pronounced in the data coming out of Asia, Taiwan as much as is China, really big surge in electronics imports tied to the build out of AI infrastructure. Huge. So, for all the talk about how things have changed, a big splurge in US capital investment in electronics means a big splurge in US imports from Asia. That trend is still there. And then you are seeing the impact of the tariffs in a sort of standard way in a reduction in trade volume in the automotive sector, but not really so heavily in other sectors yet.
Okay. So it begs the question, what was it all for? But, one of
It
the,
made the
yeah,
president happy. I
yes.
know,
Okay,
like, I mean,
good.
he loves the tool. I mean, obviously, he thinks it's given him leverage, but we've ended up, I mean, and it has generated a decent amount of revenue.
Yes, yes, that's true. And that was clearly in his motivations. I mean,
But
because
not in
we've,
his court defense. His court defense is these are not about revenue at all.
yeah,
Oh.
well, it's a nice benefit, I guess, if you can get it. I mean, this is interesting because this was kind of the big episode we saw in 2018, I think, with the initial tariffs on China was rerouting of trade. And I think the belief was this time around that that would be maybe a little bit more constrained because it was happening to everybody. But is that right?
Look, I mean, I think people came in expecting a replay of Trump 1,
Yeah.
and I certainly had some of that in my mental model.
Yeah.
And as a result, the solution to the Trump 1 tariffs was rerouting. It wasn't reshoring.
Yeah.
And so very strong, very rapid rerouting is what you see in the data. I think in the end, that rerouting may not have been ratified by policy if the tariff on China ends up being roughly the new tariff, there are higher
Yeah.
legacy tariffs, ends up being roughly where the tariffs on Southeast Asia were. Now, that said, there's more uncertainty around China. There's a greater risk that China will slap export controls on. There's still reasons why you might not want to be 100% dependent on China. But in general, I think the surprise, I mean, there's lots of surprises. One is that pharmaceuticals ended up with no tariffs. Obviously, the pharma companies would not have, pulled forward so many imports if that was their expected outcome. But the other surprise, at least to me, and I think it's a surprise relative to the campaign expectations, is that there's no meaningful difference in term two tariffs on China and Southeast Asia now. And that's a surprise to me.
Actually, that recent agreement, particularly on export controls on rare earths between the US and China, I mean, for me, and I'm just curious to get your thoughts on this, that felt like a kind of a big climb down moment where we sort of hit the peak. And as you say, we kind of normalized relative to the rest of the region. Would you say that is as impactful of a relationship changer and we kind of move away from this sort of peak deglobalization where, as you say, not a lot has changed. Trump's happy. And we are now moving in what looks like a more constructive direction. We're seeing this with Switzerland as well. I mean, what's your assessment of the state of play of this?
Well, I think Switzerland's a bit a unique situation.
Okay,
I mean, the Swiss didn't really expect to be on the losing end of the
that's
tariffs,
true.
and they had to scramble when they sort of missed the boat and didn't realize that, that when the EU made some unexpected concessions, they needed to do more, and they weren't ready to do that at the time. Look, I don't actually think we can have peak deglobalization because we haven't deglobalized a bit. I mean, you look at the trade data, China's posting record trade surpluses. Taiwan it just posted like a $15 billion monthly custom surplus. East Asia is posting record trade surpluses. That's not just trade inside Asia. That is the counterpart of the US deficit. The US deficit has not gone down. There's all sorts of talk about deals in pharmaceuticals that may or may not lead to some reshoring. We don't know the content. We don't know if you can do that just superficially by doing fill and finish without changing the location of active pharmaceutical production. But as of now, we're importing record amounts of active pharmaceuticals from Ireland, still from Switzerland. Remember, the big tariffs on Switzerland had an exclusion for gold and pharma. So most trade with Switzerland was always excluded from Singapore. So the tax enabled part of globalization hasn't come down. I would actually like to see a bit of deglobalization. And it would be really nice if American pharmaceutical companies weren't booking all their profits in Ireland and Singapore, and we're actually making drugs in the US and paying tax in the US. We just haven't yet seen it. And same on the electronic supply chain. So I think we probably are at the inflection point, I would guess, in part because, China has shown that it's willing to punch back and to use export controls, in part because it looks like a decent tariff on trade with Asia is here to stay, that we may have reached and in part because TSMC and others have been kind of coerced into investing in the US. We may be at close to peak globalization, but I don't think we're anywhere near peak deglobalization. And I think what the deal with China showed is that not only can China punch back, but it knows how to land a punch. And for the first time, the nature of the negotiation shifted. It wasn't what can China do to avoid an even bigger US tariff. It was what can the US do to get China to roll back some of its export controls. And so we've entered into a very different negotiation with China than was the case in Trump's first term. There's a lot of reasons for that.
Mm.
Some of that is because China's evolved. She got ready. Some of that is I think Trump made a mistake by escalating so far and kind of basically unilaterally walking back. So his threats of escalation have lost force.
Right.
But there's no doubt in my mind that the tenor of the negotiations has shifted. We're not in a position where we can lug big tariffs on China and not expect meaningful retaliation that has an impact here.
You've written a little bit about this, I think, on Twitter as well as on your blog about the Chinese side of this, where as you mentioned before, surpluses haven't gone away. If anything, that just kind of the status quo is there. But it's more to do with kind of China's growth model and the mercantilist policies that we've seen in the past seem to be reasserting themselves. Is that a response to the global trade environment or the response to Trump, or is it really just kind of falling back in their case on the things that got you to where you were in lieu of a pretty weak domestic demand environment?
It's two things. One is it's a long-term strategic goal of China to reduce its dependence on high-tech imports. China's willing to rely to some extent on imported iron and imported soybeans, but China never really wanted to rely on imported semiconductors, imported advanced materials, imported aircraft, imported cars, imported car engines. So across the spectrum, China's had a long-term policy of indigenizing, in the Chinese term, or creating a local supply chain and a technological capacity in their economy and their education system, which has started to bear fruit. I mean, it hasn't caught up everywhere, but in some sectors it has caught up, and in some sectors China's established a dominant position over certain inputs into an advanced industrial economy. That's trend A, and that actually predates Trump's trade war. I mean, it's President Xi, but it has deeper roots. The second effect is that, hey, China had reduced its reliance on foreign demand after the global financial crisis with a massive property and real estate boom. That boom burst in the middle of the pandemic. It kind of got obscured somewhat in the data because the bursting of the boom coincided with the full lockdown, the complete isolation of China in a physical sense. Not the containers still flowed in and out, but people didn't. But the downturn in the property market that started in 21 really has changed the structure of China's economy and its growth. And so the domestic side of the economy is lying flat, to use a Chinese term. You just don't see strong growth in household spending. You still are seeing an ongoing downturn in property investment. That has been offset by sort of an induced investment in manufacturing, which now looks like it's slowing. And then throughout this, China's just become old school. Let's rely on exporting to the rest of the world to make up for the weaknesses in our internal demand. So, one statistic that I like is that over the past 5 or 6 years, China's exports in volume terms are up 40%. That's decent. Global trade's growing 3-4 throughout this. I mean, it's up and down because of the pandemic, but that's kind of your baseline. China's at 6-7. And then Chinese imports, good God. I would like for them to be able to say they've increased by 0 percentage points, but they've actually increased by 1 percentage point. But it's basically zero. That is inconsistent with an economy that officially is growing at 4% or so. And so this huge delta between exports, which are growing quite fast, recently over 10%, and imports, which aren't growing, has meant that China has gone back to getting an extraordinary share of its growth, and probably a bigger share than reported, just from exports. And that
Yeah.
has, you're really seeing that impact the rest of the world, particularly in the past couple of years.
Yeah, and as you pointed out, I think it was this morning on Twitter, that detracts, you and others have pointed out, it detracts from global growth. And I guess the question then is, given what we've talked about with respect to the US-China relationship, how willing is the rest of the world to accept that? I mean, I'm especially thinking about Europe here, and particularly given where China is competing with Europe on EVs, on machinery, on green technology, this sort of sucking in demand from the rest of the world at the expense of your own demand. How sustainable is that? We've already seen some of the reaction to that from Trump, but will the rest of the world get on board with this as well?
I mean, I think European politics are slowly shifting, policies are slowly shifting. So far, a lot of the responses have been ineffective. Europe still wanted to follow the WTO rules, did a lengthy investigation into Chinese EV subsidies, put in place a modest tariff on BYD and Tesla, and a higher tariff actually on VW's EVs, but it was only on battery electric vehicles, plug-in hybrids, which are essentially a battery electric vehicle with a small motor. They were not covered because the investigation didn't cover subsidies into up to plug-in hybrids. So guess what? Imports from China are coming back up, or actually growing and above their previous levels because of this shift to plug-in hybrids. So, the European response is a bit conflicted. On one hand, you do see for the first time real pressure to close down the European market in response to one-sided trade, imports but no exports. You do see German auto companies or German auto workers worry about losing their jobs. And German politicians worry about the fall in German which is giant. German auto exports to China are on a trajectory to go back down to zero. But then you also have constraints. The German auto companies, a lot of them still don't want to give up on the Chinese market. Some of them actually look to produce, electronic systems, so like the brain of a smart car in China to put in their European production. Some are actually looking to produce in China the entire EV and sell it back to Europe. So there's countervailing pressure there. And then there's the dependence. I mean, the Europeans got the Nexperia case showed that China can cut off your supply of low-end auto chips, and then that can shut down production. And so therefore there's countervailing pressure there. The French are worried about imbalances, i.e., this one-sided trading relationship, but they're reluctant to have fully confrontational relationship with China at a time when their relationship with the US is uncertain at best. And so they're looking for a sort of cooperative, negotiated outcome. So it's moving slowly. There's recognition now that China's growth model is a problem for the many parts of the world, and Europe in particular. I could talk about some parts of Southeast Asia too. But there isn't yet a willingness to go full Trump, to tear up your WTO commitments, to just levy a flat out tariff and say, hey, this isn't working for us. There's still a desire to try to maintain a more constructive dialogue with the Chinese. But if nothing changes in 2 years, I think, and the current trend continues, I think we're on a trajectory where there'll be some kind of Trumpian rupture between China and Europe, and maybe parts of Southeast Asia, though Southeast
Right.
Asia is a more difficult position. But Indonesia and Thailand, they're worried about being overwhelmed by Chinese exports too. So it's not just a advanced economy issue.
Yeah. Yeah. Is that a political issue that forces it, do you think? I mean, it's always struck me, especially with respect to EVs, that it's sort of like the wanting to work with China on trade from Europe's perspective always felt to me a little bit like turkeys voting for Christmas. Is it kind of that trying to provide a countervailing force to the US, or is it actually ultimately working with the U.S. and more in Europe's interests vis-a-vis China?
Look, I think it is more in Europe's interest to work with the US
Mm,
and to basically create an open transatlantic market. And you could expand it beyond the transatlantic, but that'd be the kind of the core. And then kind of wall off most of that market to Chinese, at least autos, some other productions, kinds of production. To me, that's the right approach. Now, Trump said he didn't want that. The Europeans were kind of testing Trump out on that at the beginning of his second term. And Trump said very clearly, no, we don't care what you do with your relationship with China. You can put, you're going to put tariffs on China up for your own reasons. That's not going to stop me from tariffing you. And so that has been one constraining factor. Trump hasn't wanted to integrate more closely with allies as they separate from China. That's just not his vision. And then on the European side, there's still a bit of confusion. And I call it kind of like the VW issue, because VW as a firm is not clearly committed to producing in Europe for the European market.
mm,
VW as a firm sells, I think, more cars clearly sells more cars in China than
yeah.
they sell in Germany. Maybe it's close when you look at all of Europe relative to China, but VW wants to protect its position in the Chinese market. And it feels like the only way it can protect its position in the Chinese market is by becoming more of a Chinese firm. More production in China with more Chinese components, Chinese batteries, Chinese electronics. And then there's a part of VW that says the only way we can make money on EVs is once we get the Chinese supply chain up and running. China is the most efficient location for production, cheapest, most subsidized. Let's just use that to supply the European market. And I do think that is ultimately a problem for the German economy. VW may succeed, but the German economy would not.
Yeah.
And I think ultimately German politics will have to divorce in some sense from the interest of those German companies who would rather produce in China than produce in Germany.
Mm,
But that's a difficult divorce. And like the political system isn't quite there. It's getting there. And then the US, to be honest, has made it hard
right.
with an adversarial relationship. It wants to go it alone. And, I think there's an element of Trump's own thinking that, it's more fun dealing with the Saudis and dealing with the Chinese, dealing with autocratic leaders who can make extravagant promises and throw money at you because they have a lot of state investment vehicles. Whereas the Europeans are bureaucratic, rule bound, and the commission can't direct investment in the US the way China can direct investment or way the Saudis can say the public investment fund should be investing. So Trump himself doesn't seem keen on this vision of allied scale. But I think that's a huge error. So I think if I had a forecast, and it's an optimistic forecast from my point of view, in 3 years, we're going to have a different policy. And in 3 years, Europe's going to be in a different place because China's not leaving them with much choice.
Yeah. That's a good segue to what I wanted to talk about next, which is kind of the other side of the current account dynamics, which is the capital account dynamics. And as prelude to this, I have to say I've been working in FX markets for nearly 20 years. And when I started, it was actually your blog, Follow the Money, that I read like every day to kind of learn about the market. And particularly, we were then at a time, this is 2006, say 2007, where it was, Chinese current account surplus being recycled into treasuries. That was creating the conundrum of long-term lower yields. But it was also working in FX, all about reserve diversification flows. And
Mhm.
so we have similar environment, trying to generating enormous surpluses, but we actually hear the opposite dynamic of people wanting to move away from treasuries. So that was my question is, what role does China still play in treasury markets? Is it lessened? Is it really diversifying away, or is it just kind of doing so through other means?
Well, thanks for reading my blog. I appreciate it. I mean,
20 years now, man.
yeah, that was in the days when I was like a hardcore blogger and I blogged pretty much every day.
Yep.
It was too much work for the modern me. Yes, in some deep sense, the world did change because, as you said, from 2002 to roughly 2012, you could basically track the global flow of funds by tracking reserves. And then you could, based on the increase in reserves, once you understood some of the quirks, flows through London, custodial bias, you could more or less track flows into both treasuries and agencies. Treasuries and agencies before the crisis, just treasuries after the crisis. And it was a very clear correlation. current account surplus, reserves, treasury flow. China more or less stopped doing that in 2012. They stopped adding to their reserves. All the incremental growth in the state's foreign assets, and is very much the case now, is going through the state banking system. And when they stopped adding to their reserves, and they did a bit of diversification in the sense of bringing their reserve share down to initially 58, now 55, which is low and below the global average. But then when they moved the money into the state banks and the policy banks, a lot of that is in dollars. So it's been a bit of a fake diversification. But on the Chinese side, yeah, you do not see a direct flow into treasuries. And I don't think you see much of an indirect flow into treasuries. Now, has been a shift away from using the Federal Reserve Bank and other US custodians to using offshore custodians. So China's visible holdings have gone down. But at least when I do the adjustment, the offshore holdings just kind of keeps that portfolio flat, which is a change. It should be on an upward trajectory. So you see an awful lot of short-term dollars being built up in Asia, which are then available and lent out to the global financial system. I think aid data is coming out with a report that will show that Chinese state banks actually have been pretty significant lenders into the US market. So you've had a shift from kind of money going into the reserve account, going into treasuries, to money going into the state banks, and then the state banks making loans. You also see a buildup in the state bank's bond portfolio, which presumably is more heavily weighted towards corporate and offshore dollar issuance. So you see, kind of in some deep sense, China reducing its flows into the treasury market, and China not, in my view, really diversifying that much out of the dollar, because the money that's shifted into the state banking system is so largely in dollars. And so that's it's a fake diversification.
Yeah.
I guess the other thing I would say is that this does mean something interesting for the treasury market because, back in when you were starting, when I was blogging like crazy, reserve accumulation actually far exceeded treasury issuance. And then issuance kind of caught up, but after from '08 to 12, kind of crazy reserve growth, but crazy, issuance from the treasury. So there was plenty of supply. Now treasury supply is it's roughly 5% of GDP even with the bill issuance. Maybe it'll go down, maybe it'll go up, but roughly. And inflows from the rest of the world, visible inflows are 1.5, maybe 2 percentage points of GDP. So we're in a world where onshore and often leveraged money. There's an interesting Fed article that says it may be offshored through the Caymans and we're not counting it right. But the marginal buyer of a treasury is no longer a central bank, it's a levered hedge fund. And that is a
Mhm.
significant.
I mean, you mentioned the Middle East before in comments about trade. I mean, are they playing, in particular, I'm thinking of the sovereign wealth funds that are rising up there, in lieu, in a lot of senses, of the central banks themselves? Are they playing bigger roles at all and taking up some of that slack, or is it strictly just going to these kind of levered vehicles you talked about?
Well, first of all, it really depends on the price of oil. When oil was at
Yeah.
110, 120, yes. But the sovereign wealth funds typically would go into equities, so not into bonds. And there's a separate flow right now from everywhere into the US equity market, which has been a bit big and a bit crazy, at least in the last, we're all operating off lag data because of the shutdown, but the last data points suggest a kind of crazy flow globally into US equities. So right now, I would say the oil flow writ large is as small as it's been in 20 years. The Saudis have a pretty big current account deficit. They're going to come and celebrate all their U.S. investments, but all those investments now have to be made with borrowed money. The Saudis, they're on track, are already the biggest component of the biggest emerging market dollar bond index, the MB. The public investment fund takes out large loans. Aramco takes out large loans. The Saudis actually are really big borrowers, not really big investors right now. And any investment is done with borrowed dollars. The Emirates are a bit different, and they can always reallocate because they have such large gains from their investment in the U.S. equities market over the past 20 years. They can kind of shift that around. The Norwegians, a little bit the same story. The Norway's sort of an interesting one because we know what they're doing. And they're the one fund that's basically a true portfolio balancer. So as equities have gone up in value, they reallocate the flow to bonds to kind of keep their equity weight from getting up. So the Norwegians actually are one of the few big buyers of bonds left. So I mean, it's never a consistent story. But the overall story within the oil world is that that's not the central flow right now.
Yeah. Yeah.
Oil's prices are too low, ship prices are too high. The surplus now is really in Asia, not in oil. And so it's China, it's Taiwan, it's Korea, it's Singapore.
How much of the inflows from abroad into the US market, into US equities specifically, how much has that been a driver of dollar valuation? I wanted to start to think about the dollar within all of this.
I mean, there's some massive questions about measurement even before the shutdown. But if you did the story up until the end of 2020, I would say equity flows have in general not been an important driver. It was a bond market yield differential, U.S. highest yields among the highest yielders in the G10, just pulling money out of low yielding Asia, and low yielding Europe. It was a return pickup, fixed income, lifers, similar institutions that have a bit of a bias towards coupon and fixed income. That has changed this year, and particularly changed after Liberation Day. And you have seen a little bit of a fall in bond inflows this year, and it's been a shift towards equities. So this year, unlike the previous, I would say close to 20, the bulk of the current account financing is likely to come from equity flows. After Liberation Day, the bid that supported the dollar, in my view, was foreign equity investors buying on the dip. And that flow has been giant. I mean, we're looking at 4 percentage points of inflows from equities, portfolio equities, which we almost never get on net,
Yeah.
if you project out through Q3. And, arguably foreigners are making a massive mistake. They're buying at peak valuation. But that, to my mind, has been the incremental flow that has held the dollar up, particularly vis-a-vis Asia. And that has led the dollar to sort of modestly rebound after the Liberation Day shock.
One of the things we spend a lot of time on, because we estimate hedge ratios of foreign investors.
I would really love
Into
for you to share your proprietary data sometime, but
I can send you a chart. That is
yeah.
for certain. I'm just curious because this ties as well into. I alluded to a piece you wrote about the dollar's performance during the financial crisis and how it wasn't really a safe haven as much as people kind of make it out to be. And that's sort of what we're thinking right now is this correlation shift between changes in the dollar, changes in equities, and that either becoming uncorrelated or maybe even positively correlated to the point where you would want to hedge. Do you have thoughts long term on how that might change, how those inflows may, they may be going into the equity market, but they may not necessarily be dollar positive?
Most of the inflows into the equity market this year have probably been on net dollar positive. Yes, there's been some hedging, but it's not fully hedged. So it's got to be a net
Yeah.
positive.
Yes.
Going forward, I fundamentally believe in the correlation shift, partially because I think the correlation was a bit overstated. I mean, it's a fake positive.
Yeah.
Equity went down, the dollar went up. They did not go up for the same, equities went down because the global economy was going to. The dollar went up because a lot of people have been funding in dollars and the carry trade unwound in the global financial crisis. So the dollar went up for the same reason that the yen went up in the global financial crisis. It wasn't people seeking to put more money in the US, it was Americans who lent money to the rest of the world pulling their money back.
Yeah.
I think it's going to, we don't have that dynamic. The US is a destination currency in fixed income carry trades, high yielder in the G10, and is in a sense a destination for people looking for equity outperformance. And as the marginal source of funding for the current account becomes an equity flow, if you lose that marginal source of funding, the dollar, the US will be underfinanced and the dollar will go down. So I do think there will be a forward-looking correlation shift. But I think, the trigger could be higher hedge ratios, which basically separates out ownership of US equities from ownership of the dollar. Or it could be a fall off in demand for US equities. I'm sort of neutral on what the underlying driver will be. But then, the next year, I mean, we're going to have a Trump Fed chair, probably if Jay Powell steps down from his board role, a Trumpian majority at the board, not necessarily amongst the regional governors, and presumably a rate cutting cycle that may have some impact on dollar dynamics as well on the fixed income side. And that matters for all this, the hedge story, because, and this has been clear with Asia in the second half of 25, where I fully confess I've been wrong. I thought Japan would start hedging, and Japan obviously has not been hedging. And the yen is incredibly weak, the dollar is incredibly strong. But as the rate differential comes down, just because the U.S. starts cutting rates more aggressively under a Trumpian Fed, that reduces the cost of hedging, and it would be rational for most of Asia to increase their hedge ratio, because right now they are very, very exposed to a dollar sell-off. And, they need to kind of lock in some of their gains on the dollar, particularly in Japan. But I would say it's a little harder for Taiwan. Who do they hedge with? Some, the crazy Korean day traders who are into crypto and the Mag 7, maybe they're not going to be the natural hedgers, but some of the more, the lifers, the NPS, and they really should be hedging more.
Yeah, I mean, that's kind of our long-term thesis on the dollar is that correlation flipping, the cost coming down is a big part. How much do you attribute any future dollar weakness to the dollar losing kind of reserve share or de-dollarization? I guess it's been a very gradual process that's been ongoing for years. So the dollar is still, as a share of reserves and as a share of invoicing currencies and currency market turnover, still punching well above its weight. Do you just expect those trends to continue in gradualist fashion, or do some of the political things you talked about next year maybe accelerate that process at all?
I find the de-dollarization debate a bit frustrating. In aggregate, the U.S. is running a 4 to 5% of GDP current account deficit.
Yeah.
In aggregate, that current account deficit is being financed not by the U.S. selling euros or yen or yuan denominated claims to the world, but by selling dollar denominated claims. So in aggregate, the dollar long is going up.
Yeah.
And in aggregate, that dollar long has gotten to be really, really, really big. And that is completely separate from the fact that over the past 10 years, no one has been adding any meaningful sums to their foreign exchange reserves. So the story is not de-dollarization of foreign exchange reserves. It's no growth in foreign exchange reserves and basically a stable reserve portfolio. Now, at the margin, maybe China has shifted a little bit away from dollar in their reserves. At the margin, clearly there's been a big increase in state banks' foreign assets in China. I mean, the latest BIS data puts Chinese state bank foreign assets at close to $3 trillion, which is, only 600 billion less than their formal reserves. It's a huge sum of money. And the bulk of that is in dollars. Think about it more broadly. The real issue is not, is the existing stock of dollar reserves going to move around in some big ways? It probably won't. Stability is a pretty good bet. It'd be hard for China to go much below 50. The real question is, if the dollar weakens, will central banks resume reserve buying and act as a countervailing source of pressure that supports the dollar? And will you see a resumption of dollar reserve buying when if the dollar comes under pressure in the future? That's what past patterns would imply. May or may not happen. And then I think the bigger question is on the private side, where the dollar long, if you include US equity markets, has become extraordinary. I mean, like a typical large cap global equity fund will actually have a higher dollar share than the dollar share of global reserves. So the equity market overweight has actually become more significant than the dollar's reserve share.
Mhm.
And so to me, the discussion about de-dollarization is kind of just missing the point. The world's portfolio is becoming ever more long dollars, and in aggregate, ever more long unhedged dollars. There's been some important shifts in who, some people hold dollar assets without having dollar exposure because they've hedged. But some other people, probably predominantly like the Chinese exporters sitting on dollars offshore and the banks who provide the hedges, they're just long dollars short term. So, I mean, I think there's too much discussion, frankly, of de-dollarization. Like there's too much discussion of deglobalization. The world's still globalized. Trade's imbalance are as big as ever. Global trade is still growing in line with global GDP, despite all the shocks. Our strategic dependencies on China haven't gone away. We're still relying on rare earths and on pharma. And the world is still finding excess returns in the US dollar and increasing their dollar long. And that shows up in the net international investment position in every data set you look at. So I just don't understand why people are so obsessed with de-dollarization. It hasn't happened. When it happens, we'll know it, and it'll
Yeah.
happen first from the private sector And then it becomes, will the public sector offset de-dollarization in the private sector by adding to their reserves or not? It
Yeah.
becomes very binary.
Yeah. Well, actually, as a final question on currency, and you alluded to Korea and Taiwan, and even overnight, we've seen some pretty wild movements in things like the Taiwanese dollar, which it's been more interesting this year, but they tend not to be very volatile currencies because
Yeah,
they
because
are.
guess what?
Yeah,
The CBC smooths like crazy,
yeah,
except when it doesn't.
exactly. And so yeah, you had this apparent agreement that they wouldn't be doing that, which really pushed the Taiwanese dollar up overnight. Then it's come back probably because of some smoothing operations. But we've seen sort of this talk this year that the historic perceived undervaluation of Asian currencies, and it's not really perceived. We've talked for 45 minutes about persistent current account imbalances that are likely going to be driven by currency valuation. So how realistic do you think is a kind of reverse Asia crisis that we talked about earlier this year, where they revalue and they do step away from kind of keeping their currencies under wraps?
Well, I mean, it's a real risk for Taiwan. I mean,
Yeah.
once things start, I mean, what we saw in May is that if the CBC doesn't step in, you'll get self-reinforcing dynamics because all the unhedged investors in dollar assets have to hedge at some point. And that fuels the cycle because the open position in Taiwanese financial institutions, lifers in particular, is so big that you would just get, the Taiwan dollar could go to 20 easy, because the undervaluation is so extreme
Yeah.
and the open positions are so big. So you can get a jump. Now, the CBC will smooth. And, you can interpret the Treasury statement in two ways. You can interpret it as, well, we actually allow some smoothing as long as you say you're not targeting a level. And,
Mm.
we will get into a debate about when smoothing becomes targeting a level.
Mhm.
I would say Taiwan has targeted levels under the name of smoothing for a long time. And then in theory, it's supposed to be symmetric. But if the pressure is one way, what is the kind of smoothing that is allowed and what is the kind of smoothing that is not allowed? I know the yen is weak and is getting weaker, but I also think there is a risk of an explosive appreciation if Ueda gets off his hands and starts tightening, and
Yeah.
if the Fed aggressively cuts, because there's a lot of unhedged positions in the Japanese financial system that could hedge. And I think Korea is the hardest because Korea, it's like less clearly driven by the dynamics of one specific subset of investors. You have a structural outflow, which so far the Treasury has not complained about through the National Pension Fund, because they're targeting returns, they're not targeting a currency level. And
Mm.
Governor Rhee will maybe have them hedge a bit because they're hitting, the won is now incredibly weak and they're at those levels. But the Korea, it's the MPS, it's a little bit the lifers, but it's a little bit just retail preferring US tech stocks to Samsung and buying crypto and, chasing yield and return.
Mm.
And so it's not one flow, but you could see, the Korean surplus is now big again. And in dollar terms, it's back at record levels, 110, 120
Yeah.
billion. You could certainly see that driving some kind of correction. I guess, the simple way of saying it is valuations are extreme levels on the weak side. Open positions are also quite big. So
Yeah.
the fuel for a rally is there. But the overarching assumption is that the central banks and policy actors, who are still big and big players in the market, won't allow it. And so long as they don't allow it, you still get carry on the US side. People have in general this year actually ended up adding to their dollar longs, not hedging them.
Yeah.
It's a strange outcome.
Yeah. It's a fascinating outcome, and it's been a fascinating 45, 50 minutes with you, Brad. We're not even going to get a chance to talk about Argentina, which is a bit of a shame.
Oh, we can.
So I don't want this to go overly long and take up too much of your time. I mean, it's been one of the more fascinating EM stories for me this year. Where are we now, and how meaningful would further depreciation of the peso be in helping to rebalance the imbalances in Argentina's economy?
You can say, well, we've had a 15 to 20% move already. What's the need for
Yeah.
more? Which is a little bit the view of the Argentine authorities. On the other hand, at the beginning of the year, the peso was extraordinarily. So we're basically, the way I look at it, we're at the peso valuations of President Macri 6, 7 years ago, which are consistent with an ongoing current account deficit. And I think ongoing current account deficit plus the refinancing need on the bonds, which now slowly are starting to mature or amortize, is such that it makes it very hard to accumulate reserves. So it becomes a decision, a choice about whether you run the economy with no reserves and the expectation of U.S. support, which seems to be what the Argentine authorities now want to do, or do you actually let the peso weaken, try to get rid of the current account deficit, and be in a stronger position to rebuild your reserves, which is what the IMF wants. My personal view is that Argentina needs to complete the adjustment. It needs to let the currency depreciate further, make vacations expensive. I mean, that's been
Yeah.
one of the big sources of outflows. Make imports a bit more expensive. It's not a pleasant mechanism of adjustment, but it is a mechanism of adjustment. And then, because I'm actually worried that exports are at a unsustainably high level because they did some things to pull revenue forward to get FX in ahead of the election.
Mm.
Soybean prices are probably going down, not up. Any case, I would be worried if Argentina is essentially counting on high export proceeds and a U.S. backstop to make up for a lack of foreign exchange reserves and to allow an ongoing current account deficit. That feels to me like a policy mix that sets the stage up for a future trouble or yet another bailout. Argentina went through $14 billion from the IMF earlier this year. They didn't go through the full 20, they got maybe 3, and then the expectation of more. If Argentina pursues a policy that doesn't rebuild reserves, and if it has to draw on the swap directly or indirectly to refinance some of the bond amortizations, because otherwise it'd be too costly, et cetera, I think you're setting up Argentina for the need of yet another bailout, which maybe they'll get, but personally, I don't think they should. I think, they need to stand on their own 2 feet, rebuild reserves. They can do it.
Yeah.
It's just a little more painful. Complete the adjustment, and then Argentina would be, a perfectly reasonable high-risk emerging economy to hold. As it is now, I worry, the market's a little ahead of itself, and the Argentines are choosing the riskier of two paths.
Is there a limit to that insofar as, so they're, looking at their export basket, it's heavily agricultural based. And, presumably they still don't want to scare off external creditors. A bailout is possible, but at this stage, it's another bailout, and who will invest? Is there kind of a middle ground that you think for that is more sustainable for them to build reserves without really choking off growth?
You're off the ban now. I mean, you could be buying some FX now. You'd just
Yeah.
be accepting that you're going to move the FX market equilibrium to closer to the edge of the band. You could allow the band to widen, particularly when you're not at the edge of it, and thereby allow more scope for movement.
Mm.
And ultimately, I do think the peso is still too strong.
Yeah.
And so it needs to move another 10-ish, 15-ish percentage points. But I mean, in the grand scheme of things, that's not a giant adjustment. I just think it's a necessary adjustment. That is not inconsistent with growth. It'll mean that Argentines feel a little pinch on the cost of living. And, Argentines will get to have a wonderful vacation in calendar 2025 that they don't get to repeat in calendar 2026. I mean, I'm sorry, but if you've borrowed 55 billion from the IMF with no prospects of repaying, I think it's reasonable for the IMF to say the exchange rate has to be set so that we are not subsidizing Argentine vacations. And there's an additional exposure to the US, there's additional exposure to China. Until Argentina has rebuilt its reserves, I'm sort of a hard ass on this. The world has to demand that Argentina rebuild its reserves because Argentina is relying on the world's money. And they have to have a credible prospect of paying the world back, not just refinancing 5 billion of bonds and covering, 5 billion of coupons and another 5 billion in the central bank dollar paper. There needs to be a plan to pay the IMF back. That's an old-fashioned, old-school view of things, but I think there needs to be a little bit more old-fashioned, old-school views around external adjustment on deficit countries, and then also, old school, like China's surplus is now too big. The world needs to sort of basically put an ultimatum to China and say, we're not going to keep taking your exports anymore. Time's up. Hard message to deliver them.
Yeah. Yeah. But it's taken us full circle, actually, right back to where we began, which is how I always like to do things. This is, Brad, my last episode before the Thanksgiving holidays. So I did have one more question. What is your favorite Thanksgiving side?
Actually, it's not a side. To me, it's the centerpiece. My mom who's passed away several years ago, has
Yeah.
a wonderful apple pie recipe, which is much tartar than a
Okay.
typical apple pie. So, I could ditch the turkey, but I will never ditch the apple pie.
Fantastic. An excellent way to close it. Brad Setzer, it's been great to meet you. Thank you so much. It's been fantastic and fascinating to listen to you.
All right, thanks for inviting me.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.